8 charts that are going to give you reason to remain positive and optimistic about the performance of the stock market for the rest of the year. Let's get into it. First off, the full year has never been lower after the stock market has gained 7% in the first quarter. These are all the times historically in the last 80 years where the first quarter return was more than 7%. The full year return averaged 23, with the median being 24, significantly higher for longer. 100% of the time the market was higher. Obviously, historical past returns don't guarantee future performance, but it's a heck of an optimistic sign. This chart gives you another reason to be optimistic. It's the S&P 500 seasonality chart for the month of April. As we see here, historically, the month of April over the last 75 years is positive to the tune of about 1.6%, a very strong month, and typically happens in the first half of the month. This chart here talks about the index gains in the past 7 years, past 20 years, past 10 years, and more specifically the pre-election years. This third year, 2023, is a pre-election year with an election happening next year. Very strong month of April historically, almost 4% in pre-election years. Why? This is around the time when campaign promises are made, there's positive development happening around the election, primaries are coming, and there's generally positive momentum around the market. Spending is announced, etc. Over the last 70 years, April has been good, but over the last 20 and 10 years, it's been even better. Another reason to remain optimistic at this point right now is that over the last 20 years, any 2 consecutive quarters of gains has always equaled a new bull market. In other words, you don't get a positive month followed by a continuation of your bear market. Take a look historically, the data shows it. We've now had 2 consecutive positive gains, 2 consecutive quarters back-to-back gains. Historically, that means the bear market is over. Another reason to remain optimistic at this point is a technical chart. This chart represents SPY, which is an ETF representing the S&P 500. On a technical basis, it's been trying to break out in this red shaded area in the middle above 405 to 410. It's tried to break out now 5 consecutive times. There's resistance. There's people selling at that point, which means that it's resistance. The S&P cannot go above that. Well, recently, the S&P 500 closed above this technical indicator, closed above it, traded above it. Now means that it looks like a breakthrough is happening, which is a strong sign if you're bullish. Q1 is now over, so another reason to remain optimistic. This chart shows every single time that the stock market stayed above the December lows. So when the entire quarter trades above the December lows, what happens? What does that mean? So the December lows in 2023 for the S&P 500 were 37.83. The Q1 low was 38.08. If we look at the percentage of time that this is a positive indicator over the last 75 years, 94% of the time it's a positive indicator, with only very, very minor negative months happening in 2011 and 2015. We're looking at an average total return for the year of 18.6% with a median total return of 18.1%. If you believe that historical patterns matter, this is a very bullish sign for the stock market. Here's another chart and a reason to remain optimistic. The last tightening, the Fed policy rate, so the last tightening of the US Fed overnight rate is often, but not always, followed quickly by a cut, meaning an increase and then we start seeing cuts. So this is historically every time we've seen tightening all the way into cutting, and the last rate hike historically followed by a cut. And we all know that cuts are good for the stock market. Quantitative easing is a lot better for the market than quantitative tightening. Here's another chart and a reason to remain optimistic. This is a contrarian chart. What you see in front of you is a chart showing what asset classes are most liked and what asset classes are most hated. You can see with this chart that the most liked asset right now is cash, and the most hated asset right now is equities, US equities. Index, 4 consecutive weeks it's up. NASDAQ is at a 7-month high, and the most hated asset is US equities. Contrarian belief, perhaps. Past performance doesn't guarantee future returns, but we all know that historically retail investors are wrong. A wise man once said, if everyone is thinking alike, somebody isn't thinking. Is that happening right now with the market? Time will tell.